We have your mail?
We do.
Well, great. If you'd like to send a question in, please send it to Doug@riskandrewardtv.org. I'd be happy to answer your question. What do we have this week?
This is from Frank in Phoenix.
Thank you, Frank.
And it's kind of a long question, so I'm going to break it up into several parts and
Okay.
you can answer each one.
I'm good with that. I'm sure they're good with that.
The first little section is, do we need a stock market?
Okay. So I worry about people who ask that. Yes, we do. Absolutely, we do. Let's see if I can explain this to you. The stock market is the equity portion of a company. So you're buying ownership if you buy stock. The bond market is the debt portion. You're loaning the company money. Combined, they form the capital markets, which is capital is money. So we give money or we invest money into companies, either through equity or through debt. And the companies take that money and build plants and equipment and payrolls and marketing and sales and acquisitions and all kinds of things, and they need funds, and so they go to the capital markets and funds and raise funds. Without it, you'd actually have to know the person, say, oh, hi, Brenda, will you loan me some money so I can build an auto plant?
Friends and family only gets you so far when you build an auto plant.
You're not going to build an auto plant with my friends and family, I know that. So you need capital markets. Yes, you need a stock market. I know some of you have lost money. You probably lost money the other day too. And you're like, why do I need this? I don't need this. I just want, no problems. Well, unfortunately, the capital markets are it's risk and reward. We talk about it all the time.
So he also says, if a person wants to invest or buy part of a company, shouldn't she be able to call the company or go to the website and purchase the stock without a broker? After all, those same companies are trying to sell us their services or products, so why shouldn't they try to sell us their stock?
Okay, so yes, there are companies that will sell you their stock directly, but that's not really the issue that you're getting at. What you're getting at is, I might be able to buy shares from them, but then how do I sell them back? See, once I want to sell, the company can't give you the money back because they took the equity and built the auto plant. So they have the auto plant. They can't give you your money back.
Invested.
You own part of the auto plant. Well, you need to find somebody else to buy your portion of the auto plant. So the way this works is, if you picture, let's say Caterpillar Tractor, right, as a company. Well, Caterpillar goes to an investment banker and it says, we want to issue either bonds, stocks, or bonds. And the investment bank goes out to their customers and it says, we've got some bonds, we've got some stocks, we want you to do this. And they all give them their money, and all that money goes to Caterpillar. The investment bank, of course, gets a cut. And now all these clients have either the stock or bond or whatever the security is that Caterpillar needed to sell. Well, now if you're this customer, how do you get your money back when you need it? Because you may be a long-term investor, but someday you might want the money.
Something happens. Family, you need the money back right away.
Or you're just greedy in trading. Okay, it could be either one. And so the only way to get your money back is, instead you could trade with each other, but it's easier to just go to the market. And the market is everybody else, all these other customers that are out here that may want to buy your stock. And so you go to the market and say, I've got shares, and somebody over here goes to the market and says, I want shares, right? So I want shares. They give them money, and the money goes to you, and that's how the markets work. So you don't need to have a counterparty. You go to the markets, you sell to the market finds another counterparty, and you never need to know them. That's the beauty of the market. If you needed to find somebody, oh my goodness, how hard would that be? So that's why we have markets. That's why we use stockbrokers. Now, if you're using a stockbroker as somebody who's selecting securities for you, that's a whole different thing. We're talking about brokerages that act as an intermediary between buyers and sellers, not an advisory capacity where they're saying, you have to pick this stock, or I'm suggesting this investment. That's an advisor, not necessarily the broker we're talking about here. What else does he ask?
Well, he says, why use brokers?
I think he means advisors, but okay, go ahead.
Why use brokers who take an unnecessary cut and do things like sell short that is detrimental to people who invest? If someone wants to bet a stock will go down, let them go to Atlantic City or Las Vegas and place such a bet, put their own money at risk. Okay, so there's two things in this question. We could have even broken this down further. So why use brokers is, I just explained this.
how much would it cost you to go find somebody else to buy your Caterpillar stock? More than the $9.95 that it takes you to trade online? Yes. So the reason we use brokerages, they are an intermediary. For $10, you don't have to find somebody. That is pretty darn cheap these days. It used to be 2%. Now it's much less than that. So there's no way to get rid of your 100 shares of Caterpillar any other way. The idea on shorting, he says that he doesn't think they have their own money at risk. But we've done episodes on shorting. You're not watching the show, Frank. If you watch the show, you know
you can lose a lot.
You can lose
shorting.
a lot of money shorting. Your money is definitely at risk. They are definitely at risk when they are shorting a stock. Now, what I think you're getting at is you don't like shorts pushing the price down of your stock. Well, what shorting does is it tries to find a proper price, and if people are shorting, it's because they think it's going to go down and it's not worth what the market's paying. So what you're saying is, I don't want my stocks to ever go down. Well, that's not going to work. We don't want stocks to always go up, because then when they eventually do go down, they get dislocated. They go down sharply, a la Enron, a la WorldCom, a la Freddie and Fannie and a bunch of others. They never go down. They keep getting pushed up, and everybody believes it and this story. And then some short seller comes in and goes, yeah, the Enron thing, the numbers don't add up. And it's like, oh, you need the short sellers. In fact, you need as many short sellers as you do buyers, so the market clears.
Balances out.
Balances out. You need sellers and buyers, and every transaction has a seller and a buyer. So we want shorts in the market. We want people to come in and say, I don't think this price is too high, and then we find an equilibrium, and then we don't get dislocations where things go way up and everybody believes it's true, like housing. And there's no way to short housing, right? There's no way to come in and bring that price back down, and then when it does fall, it collapses. So people in short positions in the market are definitely putting their money at risk, and they add liquidity. That's the trading side of things. So we need a market, we need liquidity. Yes, it adds volatility and an area of risk, but risks is part of the market. You're making an investment, and it doesn't always have to pay off.
And what's your takeaway?
So the takeaway is, and we talk about this a lot, risk is related to reward, and if you want to hope for high stock market rewards, you have to be willing to take high stock market risk that goes along with it. Otherwise, the lower risk of Treasury bonds or the money market, that's available. Choice is up to you.